Welcome back, my dear friends. Previously, we explored the loan cycle and lending mechanisms used by microfinance institutions to deliver financial services to underserved populations. We also discussed the key phases of a loan cycle like application, appraisal, disbursement, repayment, monitoring, and loan closure. In today's session, we will dive deeper into credit history and financial analysis. Crucial aspects of successful microfinance operations. Just take a look at this. This is Ravi. Like many vendors in this busy marketplace, he earns a living through informal work. He has never set foot inside a bank, nor does he have a formal credit history. How can someone like Ravi with no financial documentation or credit record gain access to a loan? Microfinance provides a solution for this by creating credit histories for people like Ravi and analyzing their financial situation to enable responsible lending. Credit history and financial analysis play a critical role in microfinance. So, today we will explore how microfinance institutions create credit profiles for individuals without formal financial records and use financial analysis to assess their loan eligibility. Let's start with the importance of credit history in microfinance. In traditional banking, credit history is a cornerstone of lending decisions. It's a record of an individual's past borrowing and repayment behavior, helping lenders determine how risky a borrower might be. However, in microfinance, many clients like Ravi don't have a formal credit history. Without this financial track record, microfinance institutions must develop innovative ways to assess a borrower's risk. Credit histories in microfinance aren't just about formal records. They also include informal behaviors and the social standing. Now let's throw some light on credit history as a risk mitigation tool. For microfinance institutions, credit history is primarily a risk mitigation tool. A solid repayment record reduces the risk of default, which is crucial for sustainability of microfinance. One way MFIs tackle the challenge of limited formal credit histories is through group lending. In this model, borrowers collectively guarantee each other loans, building a group credit history. If one borrower defaults, the rest of the group steps in, creating a form of social collateral. MFIs also rely on community involvement and informal lending patterns. This helps form an alternative credit history where none formally exists. Now, let's look into creating credit profiles for unbanked individuals. Creating credit profiles for unbanked individuals, like example Ravi, requires a creative approach. MFIs use informal data sources, community networks, and increasingly digital tools to build a credit profile. So, the loan officer may ask them to tell about daily sales, how much they make on a good day, and what are their household expenses. In the absence of formal records, MFIs often evaluate business records, household financial behavior, and community standing. Business owners like Ravi may not have official financial statements, but their sales receipts, stock, and community reputation offer important insights. Now let's look upon group credit histories. In group lending, the collective behavior of borrowers creates an informal credit history. Groups like these help reduce the risk of defaults as the members watch for each other and ensure everyone stays on track. Here is an example where the group leader says, "Don't worry, we will recover your payment this week, but let's make sure you're back on track for the next one." So like this group mechanism builds trust and accountability. Over time, these collective repayments behaviors form a group credit history that MFIs can use for future loan decisions. Now, let's dive into digital and non-traditional data. With the rise of digital technologies, MFIs are increasingly using non-traditional data to assess creditworthiness. For example, mobile money transactions provide valuable insights into the borrower's financial habits. Data from mobile transactions, utility bill payments, and even social media activity can help build a borrower's digital credit profile. These innovative methods enable MFIs to reach clients who would otherwise be excluded from the formal financial system. Next, let's look upon financial analysis in microfinance. Financial analysis is another critical element in microfinance lending. Unlike traditional loans, where salaried income is easy to track, microfinance borrowers often have irregular incomes from multiple sources. Income and cash flow analysis allow MFIs to tailor loans to match the borrower's specific circumstances. Next element is expense analysis and asset-based analysis. Expense analysis is equally important. MFIs assess whether borrowers can manage their essential expenses while still repaying their loans. The loan officer might ask you, how much do you spend every month on food, school fees, or even healthcare? For borrowers with existing debt like informal loans or previous microloans, MFIs must ensure that taking on additional debt won't overburden the borrower. Expense analysis helps in crafting a loan that's manageable. Even without formal collateral, many borrowers have assets like land or livestock that offer financial security. MFIs may assess these assets as part of their financial analysis. Now let's look into financial ratios and their role. Financial ratios such as debt to income and cash flow to debt service ratios help MFIs determine whether borrowers can manage their debt or not. While these are more commonly used in larger loans, they provide insight into a borrower's financial health, even in microfinance. Now let's check out the role of financial literacy in creditworthiness. Financial literacy plays a crucial role in improving creditworthiness. borrowers who understand how to manage their finances are more likely to repay their loans on time, reducing the risk of default. In this regards, budgeting and tracking your expenses will help to make timely repayments. Remember, the better you manage your loan, the more opportunities you will have in the future. In conclusion, by building informal credit histories, conducting detailed financial analysis, and incorporating financial education, microfinance institutions create sustainable lending practices that empower individuals like Ravi to achieve financial independence. The combination of innovative credit profiling and responsible financial analysis is what allows microfinance to drive financial inclusion for the unbanked. With microfinance, the journey from informal work to financial stability is possible with one loan at a time. Thank you and stay healthy.